What's up, apes? Welcome back to everybody's favorite podcast. We are, of course, talking about the Daily Peel here today and getting everybody ready for the ticker tape tomorrow. It is currently Tuesday, June 25th, 2024 at 7:37 p.m. A beautiful evening here at the Daily Peel Global Headquarters. We got a lot to talk about here today, especially buy-side recruiting. So if you are looking to exit the living hell that is operating on the sell side and move over into a company that actually allows you to see your family and friends once in a while, then definitely stay tuned until the end of this video, because we're going to be talking about some of the important strategies going on to get there, what the market outlook is like for the rest of the year, and how you can put yourself on the best possible footing to once again escape the hell that is sell-side investment banking. But before we get into all that, we got a lot to talk about beforehand, including a couple of stocks, and everybody's favorite sandwich, the Big Mac, is going to be our big story of the day. But once again, before we get into all of that, let's talk about the WSO Alpha portfolio. So absolutely monstrous day for the apes over here at WSO Alpha. We were up an entire 2 basis points for the session, so that is 0.02% for the non-loser finance virgin nerds that, actually have real lives and go out and touch grass once in a while. Basically, we rose a little bit more than 0.00%. Meanwhile, the Nasdaq and the S&P absolutely dominated us. It was a good day for big tech once again. Nvidia was getting pumped for the first time, and well, it feels like it's been a while just because it's NVIDIA, but it's really just the first time in 3 days or so. Since we are underweight, we actually don't own NVIDIA at all. Obviously, we didn't get any of that benefit, but we think longer term, this is going to work out in our favor. So once again, always be sure to join that WSO Alpha portfolio. You can go sign up on it at Wall Street Oasis /alpha, I think it is. I'm pretty sure that's what the URL is, but whatever, fucking Google it. You'll be able to find it. Anyway, let's get into some of the banana bits for the session. So first and foremost, sign up for WSO's private equity interview course. By the way, we have a phenomenal interview course and a great guide to private equity interviews. Go ahead and click the link in the edition tomorrow. Make sure that you're signing up and you're prepared for any and all questions that could come your way as you look to break into the holy land that is mega fund private equity, or even just elite boutique private equity, whatever floats your boat the best. Or quite honestly, if you want to completely drop out and go become a ranch farmer, I respect that even more. I'll probably be joining you eventually someday, but unfortunately, now is not my time. Anyway, it was the time for Rivian shares to absolutely bust through the roof for the session. So Volkswagen, this is the world's second largest auto company, in 2023 by revenue. They invested $1 billion in Rivian, the electric vehicle maker that I really thought Apple was going to buy, especially when it was down and out of its luck for the most part, and Apple had just ditched its electric vehicle investments, its autonomous vehicle investments, really. I figured they would just buy Rivian, but nope, Volkswagen is going balls deep into the EV quote-unquote startup at this point. Meanwhile, gambling on big tech stocks has reached an absolute all-time high. Call option buying is at an all-time high on these big tech names because why wouldn't it be? I mean, it's artificial intelligence. Their earnings are carrying the entire S&P 500, so it just kind of makes sense, but it adds into that concentration argument. Meanwhile, the saga of Julian Assange, for those that don't know, this is the guy who founded WikiLeaks and basically leaked a shit ton of information about all the most important people in society. Obviously, Uncle Sam wasn't too happy about it. They've been trying to arrest and probably murder this guy for the past decade and a half, but he is currently on the island of Saipan, which is a United States territory, I believe, in the U.S. Marshall Islands, and he's there because it's close to Australia, and that's where his family is, and he's going to go back to Australia to escape Uncle Sam's grasp. He'll probably get murdered or disappeared or whatever the fuck they did to that Boeing whistleblower. I'm sure it's going to be the exact same thing for him, and just a couple of months down the line. And finally, it turns out nepotism isn't reserved for just the world of finance. The NBA falls victim to nepotism just as much as JP Morgan does, especially when you got a guy named LeBron James Jr. entering the draft next year. So we talked about basketball a lot yesterday. We wanted to give a little bit of a touch on the upcoming draft that's scheduled for later this week. So definitely go ahead and check that out if you give a shit at all about basketball. All right, let's go ahead and get into our macro monkey story of the day. This one's a bit of a stretch, but we are here to make prices great again because I don't know if you guys have noticed, but inflation has been kind of high over the past couple of years. Not a lot of people have talked about it. It's really been back in the mind, not a big important topic of conversation for general society whatsoever or anything, but we wanted to bring it to light here today just to make sure that everybody's aware. This really is the last great American institution, being McDonald's, and they are out here actively contributing to inflation, but also kind of trying to fight it at the same point. They just came out with that $5 value meal deal. But if we look at this chart, you can see what I'm talking about when I say that they are actively causing that inflation. So what we're looking at here is from it's one of the Federal Reserve banks, Bank of St. Louis. Jesus, shout out to any apes out in St. Louis. That's got to be rough, huh? But anyway, this is the graph that they presented that shows what's called the Big Mac Index. So for those that don't know, the Big Mac Index is one of the best economic indicators out there. It's a way to measure purchasing power parity between different currencies. So a Big Mac in Switzerland is going to cost like $9, whereas here in the United States, it's like $5.50. And in some, horrible wasteland like England or something, it's probably going to cost about the same as it does in the United States. But it basically shows the difference in purchasing power of dollar because a Big Mac is made of the same thing everywhere you go in the entire world, and it shows how costs differ in different geographies and how that currency is valued against a hamburger. So it's a great way to measure that. But what we're talking about today is instead of comparing U.S. Big Mac prices to other countries, what we're doing is comparing U.S. Big Mac prices now to what they were in the past. And that's exactly what you see in this blue line right here. So effectively what you're seeing is cumulative inflation on the consumer side of things. Now, this other line right here is also cumulative consumer inflation because that is the CPI, but the CPI is not a great measure, to say the absolute very least. The abomination that is owner's equivalent rent makes up about 1/3 of the CPI, so it's never a great way to look at it. So that's why we kind of wanted to expand our view and look at the Big Mac Index here today, especially because there was no really notable economic news for the session. There was a couple of Fed speeches and manufacturing index prints, nothing exciting, nothing that really got the gears going. So we took a step back and we went to the great American institution that is McDonald's. So it doesn't take a master of econometrics to realize here that obviously the Big Mac Index has been outperforming CPI since 2012. That is when this chart is benchmarked to. But if we go ahead and take another look, this is the annual change in inflation as well as inflation of the Big Mac. And so what we're seeing here is really the key piece of today's edition and of today's main story, because as we can see, the rate of inflation declines. Like eventually it does head back towards that 2% window as long as the Federal Reserve is doing something about it, as long as the broader economic scenario is changing. Inflation typically will return to the mean, but costs for products sold by companies. So think the Big Mac, think literally any product that gets sold. That is not going anywhere. Those prices are not going down. So if anybody was hoping for that whatsoever, barring a recession or a depression, those prices are absolutely not going anywhere. And that is the real big problem of the day, because what we've seen so far is obviously an enormous amount of cumulative inflation, as we can see right here and in that prior chart. And consumer spending has been able to hold up pretty strong for a couple of different reasons. The main reason being excess savings and wage growth in the post-pandemic period. So obviously, excess savings has been a big thing, especially following the Fed's interest rate hikes, because that means people who can afford to buy interest-bearing assets are earning a lot more cash. They're turning around and spending it, probably not at McDonald's, but that's keeping consumer inflation relatively elevated, at least on the economic reports that we're seeing, in things like the personal consumption expenditure, which we'll get another one of later this week, actually in just a couple of days, so that's pretty exciting. But either way, consumer spending has been able to hold up strong, and that's why these companies are getting away with maintaining that cumulative inflation to this point. Now, we are starting to see some weakness in the consumer spending data, and there are underlying reasons for it. A big one for that is because wage growth just isn't there anymore. It's not surpassing inflation anymore like it has been for the past 2 years or so. That stopped a couple of months ago. Back in April was when they kind of normalized or met each other on the same wave, and now CPI has been outperforming wage growth. And we can see this in other data as well, such as the rising unemployment rate and the rising initial jobless claims and continuous jobless claims. So the labor market is widening, it's loosening. That means there's going to be less demand for labor, which means the price of labor is going to decline. And as we all know, the price of labor is wages. So it's not necessarily true that they are going to be falling. Like, you're probably not getting a wage cut this year, but I would be surprised if your salary keeps up with inflation, especially like it has been over the past couple of years. Here's another chart showing that difference in cumulative inflation, because this is going back to the start of the pandemic period. This is April 2020. This is when this chart begins, and what we see in this blue line right here is CPI growth over that period. And in this red line, this is average hourly earnings growth for all non-managers in the United States. So this is all the bums like you and me. And as we can see, this is far from kept up, but we could be entering a period where prices start to decline. The sad news about that is that it will come with a depression. That's really the only way that we can do it. But hey, if that's what it takes to make prices great again, we might have to. As a personal anecdote, just this weekend, I went on a very quick grocery store run. It wasn't like a big run for my household or anything, quote unquote household, by the way, because I still don't fucking have a house. I actually got rejected from 2 more offers today, so it's been a lot of fun. Either way, This weekend I went to the grocery store and I thought it was going to be like $45 worth of purchases, and I swear to you I shit my pants in the checkout line when I saw that it was going to be $70, or it was like 72 something. I was like, it felt like a crime. It felt like I had just been victimized. I was ready to call 911, but unfortunately Harris Teeter, it's not like they assaulted me or anything, even though definitely felt like they assaulted my wallet. But either way, that's why we're out here trying to make prices great again and trying to understand exactly why cumulative inflation is being such a bitch, especially right now. With all that said, let's move into some of the big stock movers for the session. So first and foremost, we have Carnival Cruise Lines, or really cruise lines in general, but it was all because of Carnival here. They came out with their earnings report for Q2 of 2024. They beat sales estimates by $100 million. They absolutely smashed earnings estimates, mostly because they actually made money when Wall Street was expecting them to lose about 1 cent per share. Now, the company actually came in with earnings of 11 cents per share, so that was obviously nice to see. Investors sent the stock up 8.7%. Meanwhile, Norwegian Cruise Lines also caught a bid up 5.1% for the session. All right, so we talked about NVIDIA earlier. They were up 6.8% on the day, and there was kind of a reason for it. Not really anything that would justify like a 6.8% bump, at least in my view. But effectively, what the main reason probably is that the stock has been falling for several days in a row, and I'm sure some investors with size saw this as a buying opportunity for whatever fucking reason. But there was some recent news that came out about them. Basically, NVIDIA has quietly partnered with a Qatari phone company. So this is one of the largest phone companies in the Middle East. I think it's called Ooredoo. It's Ooredoo. So I'm pretty sure it's Ooredoo or Ooredoo. I'm probably butchering that right there, but somebody please correct me in the comments. Either way, they made a partnership where NVIDIA is going to be supplying AI resources to this phone company. Obviously, there's a lot of CFIUS restrictions that go with that. The United States isn't going to let NVIDIA give them their fucking Blackwell chips because Qatar will probably just turn around and sell it right to China or something, or wherever they can get the biggest bag. But it makes sense that the Rockefellers of NVIDIA are making friends with the Vanderbilt over in Qatar. That's effectively what we're seeing going on right now, and investors were loving it. What investors were absolutely hating for the session, however, was SolarEdge. So this was a real double whammy. You would think that given how hot it's been over the past couple of days, especially here in the northern United States and to the poor fuckers that live in London. I mean, as if living in the UK isn't bad enough already when you got to deal with 76-degree heat, which, by the way, 76 degrees, it doesn't sound like a whole lot to us here in the United States, but the way that homes are built in the UK and in Ireland and in other northern parts of Europe, or, coastal parts of Europe, they are designed for retaining heat, so it gets kind of fucked when it's, above like 65 degrees apparently. But either way, despite all this heat wave and all this nonsense going on, solar stocks had a rough day for the session, especially SolarEdge, and it was really their own fault. So the double whammy that SolarEdge faced was, first and foremost, they came out and said that they were going to be offering $300 million in new convertible notes due in 2029. So obviously that's heavy dilution for investors coming down the line. No wonder that they wanted to sell off. Selling off a fifth of the company's value for that reason, however, I don't know if that's necessarily justified, but maybe it is when you combine it with the fact that the company just learned on Tuesday as well that they are not going to be collecting at least $11.4 million that they are owed from one of their client companies. It's some Arizona-based solar installation company, and this installer has effectively said, like, hey, we're not going to be able to pay you because we are going bankrupt. So their customers, installers, are going bankrupt right now, likely due to the rate hikes and just having absolutely no demand for solar panels, especially when rates are this high. So the stock sank like an absolute rock. Speaking of sinking like a rock, Pool Corporation was also down, which was even more of a surprise given the context of the heat wave going on, but the stock fell 8%, and really it was just because they were way too honest. I mean, being way too honest is a huge mistake when it comes to Wall Street. They came out and they updated their earnings guidance, much to the chagrin of shareholders. They basically cut guidance for the next quarter by about 20%. Obviously, investors were pretty pissed about that. Other pool stocks got the message as well. So we saw Pentair. They sell like pool treatment supplies. They were down 7.1% on the session. And then Leslie's is another pool supply company. They were down 4.8% for the session. All right. Let's go ahead and move into what everybody has been waiting for. And we are talking about searching for peace, or more specifically, searching for peace. I hope I nailed that. But either way, it is recruiting season once again for the buy side. If you're one of those people that likes to go on cycle, personally off cycle, it's a little bit more entertaining or a little bit more fun to follow. But the on cycle recruiting season has started right now. We already have companies like Apollo, Blackstone that are starting to hire candidates. I actually just saw somebody from my alma mater just joined Apollo, so shout out to her. But If you want that to be you, once again, go ahead and sign up for the WSO Private Equity Interview course. They have a great guide, a great course. I have absolutely nothing to do with it, so that's how you know it's going to be very high quality. So definitely go ahead and check that stuff out, because the handshakes made, the networking emails ghosted over the next couple of weeks and months are going to determine the economic future of you and your family and what the rest of society thinks about you. So make sure to go ahead and sign up for that if you have any desire to go ahead and see what's going on in the private equity market. Now, speaking of the private equity market, our favorite certified smarty pants, Mr. Thorsten Slok, who is the chief economist at Apollo, he came out literally today or yesterday, for most of you that are going to be watching this, with Apollo's mid-year outlook for the private equity industry. So I can't imagine a better person to be talking about this. So let's go ahead and see what Elizabeth Warren's least favorite company is expecting for the second half of the year. Really, it all starts with this chart right here. So what you're seeing is their expectation for interest rates throughout the end of the year and into 2025 and all the way through 2029. So basically, what Thorsten Slok is saying right here is that the market is pricing for a minimum of a little bit over 4% for the federal funds rate over this entire period, meaning rates are going to be staying much higher for much longer. So it kind of relates to what we were talking about a couple of weeks ago with Jurrien Timmer, who's the chief economist at Fidelity. Seems like Slok and Timmer have a bit of a disagreement here, because Timmer seemed to suggest that he thinks the Fed is going to acquiesce to the market. Slok obviously thinks that Timmer thought that the market was going to acquiesce to the Fed. I might have misstated that, but Slok thinks that the Fed is going to acquiesce to the market and actually have to keep rates elevated for much longer and into the next couple of years instead of just throughout the end of 2024. So this leads to a couple of other big takeaways for the private equity landscape. Most importantly is probably going to be this one. And so what we're seeing here is the number of funds in the aggregated capital raised for private equity funds here in the United States. This line that you're seeing, this is aggregate capital raised, and then these green bars are basically the quarterly raises for these private equity funds. So what we're seeing is obviously a continued decline. A lot of people thought that 2024 might be the turnaround year, but it absolutely has not worked out to be like that. And a big reason for that is because of this chart right here. So what we're seeing now is exit opportunities for private equity deal flow. Not necessarily your exit opportunity to go into private equity, although I'm sure that's related. If this was as high as it was back in 2021 and 22, they were hiring literally anybody with a pulse and an MBA. So it's not necessarily like that. This day, what we're seeing is still a big decline, especially when it comes to IPOs and entering into the public market. So the private equity landscape is still staying basically quiet for the rest of the year. The big takeaways that Thorsten Slok wanted us to have was that these higher rates are going to cause private equity funds to seek more opportunistic investments. So it's not kind of spray and pray like it has been in years past, especially among distressed and soon to be distressed companies. That is what Apollo and, Thorsten Slok especially are going to be targeting. The last thing that he added in was that the elevated uncertainty of macro conditions right now creates this need for flexibility, furthering that need to be opportunistic, and saying that strategies that invest opportunistically across the capital stack are well positioned going forward for the rest of 2024. That's really our big takeaway for the day for the private equity cycle. So if you want to break in this year, make sure to go ahead and check out our courses once again, because they're going to help out a lot, especially given market conditions. So obviously, we had to go ahead and finish up with a quote of the day from Mr. Thorsten Slok himself. This one actually comes from a couple of years ago when he was the chief economist over at shithole fucking bank. Oh, Deutsche Bank. Sorry, I mispronounced that. But at the time, he said, to be successful, you need to get people's attention by adding value to the thought process. Some of the goal is to be a little bit wild and unusual because there's a lot of things going on that are very relevant. Shout out Mr. Thorsten Slok. He's advocating being wild and weird, and that is certainly something that we can get behind here at WSO. We're going to call it for the day. It's now 7:56 p.m. Everybody go out there, get a good night's sleep, especially if you have an interview coming up tomorrow. I will talk to you all soon. Thanks for joining us once again. Happy investing, happy trading. We'll see you guys. Bye now.